All right, well, here we are again. So we're partially through chapter 10, and we started talking about stocks and bonds and other interesting items. So we're going to continue with that today. But first, I happen to find some very interesting videos that we can look at that will help tie all this together. So let's just quickly revisit what we've done so far. We're looking at finance, investment, and saving. And so, oh yes, go ahead.
When we get our midterm grades back?
Not yet. Those will probably have to wait till the weekend. It took me forever to do the math ones, but yes, almost. They're very close. I'll try to make sure they're ready by Monday. All right. Anyway. Oh, yes. So we defined different types of capital. We looked at some key concepts like investment and depreciation and wealth versus income. Then we started to look at actual financial markets, the market for loans. And then we briefly touched on the market for bonds. We looked at the different features of what a bond is and how it's structured and what kind of returns investors can expect to get from them. We saw the different features that could be built into them. And we also talked about credit risk. Specifically, we were looking at the ratings from Standard & Poor's and Moody's and how that helps us understand how risky a bond is. We also quickly looked at treasury bonds and all the entire range of treasury securities, treasury bills, notes, and bonds. And we noted that these are issued by the Treasury Department to cover the government's deficits, and that these are considered to be free of credit risk, which means if you buy one of these, you're guaranteed to get the payments that you were promised. Whereas unfortunately with corporate bonds, sometimes something can go wrong. Corporation can go bankrupt and the investors end up not receiving all the funds that they were promised. The possibility of this happening is referred to as credit or default risk. And so how do we know how much credit or default risk each bond contains? That can come from these credit ratings by Standard & Poor's and Moody's, which will give us a good sense of how much risk there is associated with any bonds that we might be thinking about buying. The higher the higher the credit rating, of course, though the lower will be the coupon rate that you're offered by the issuer of the bond. So you have to make a decision as to how much risk you're willing to tolerate and what kind of return are you looking to earn. So as with all other financial markets, the riskier an asset is, typically the higher on average will be its rate of return. So we looked at the different kinds of bonds. There are also municipalities issue bonds of their own. This would be city, state, and local governments. And here I mentioned that they do have some default risk, although not very much. It's very unusual that an entire city goes out of business, runs out of money, I guess I should say. It can't go bankrupt. But the city of Detroit did, in fact, run out of money and was unable to pay its bondholders several years ago. And that means that there's going to be losses for the holders of these bonds. And then I also mentioned that there are many foreign bonds issued in the United States, typically by foreign governments as well as foreign corporations. Now, the stock markets, we know that stocks are very exciting. These securities provide us with partial ownership of a corporation. So the motivation for buying them is to share in the profits of that corporation, mainly through what we call capital gains, by which we mean, and of course there's the New York Stock Exchange at Christmas time, by which we mean the price goes up and you're able to sell the stock at a higher price than you paid for it, assuming that the company is doing very well. Now, we did see that there are stock exchanges where stocks are traded, like the NASDAQ and the New York Stock Exchange. But we also saw that many stocks trade through the so-called over-the-counter market, where we have trading directly between dealers and customers. And so there, in these cases, there is no physical location where this takes place. It's simply done through the internet or through telephones. Usually, by the way, just as a rule of thumb, typically the small stocks are the ones that trade in the over-the-counter market. The larger ones would typically be listed on an organized exchange. It's kind of a measure of prestige that a corporation is listed on an exchange, and so they will do everything they can to get listed as soon as possible. But For some companies, they're new and they have a lot of potential, but they're very small. They don't have a lot of market capitalization. And so for those types of stocks, they're more likely to be traded in the over-the-counter market, at least until they start to get bigger and better recognized. All right. So what else do we need to know? I think we pretty much covered all this discussion about stock quotes. So what I've done is I've put together some videos, which one of them is about bonds. One of them or two of them are about stocks, and then a couple of them are about financial markets in general. So we're going to take a look at some of these right now, and I think you'll agree that they're very interesting. And when we're done with those videos, we're going to move to the second half of this chapter where we finally get to look at this loanable funds market that we started to look at in one of our earlier videos. And so here, this is a very general discussion about how interest rates are determined in the marketplace by the interaction between buyers and sellers of these so-called loanable funds. So let's begin with the first video. This is the one that is an overview of the bond markets. And then that will be followed by some discussion about stocks and financial markets in general. All right, so let's take a look at these. First, we'll go with the bonds. All right, here it is. Let's take a look. And let's get started. Hmm. Okay, I thought they really did a good job tying together everything that we went over. Everything you need to know about how bonds work, who issues them, and the risks that are involved with buying bonds. And of course, they also did a nice job comparing them to stocks, showing how over time stocks tend to outperform bonds by quite a bit. But of course, stocks are also typically riskier than bonds. So normally in financial markets, the securities with the highest levels of risk are typically also the ones that provide investors with the highest rate of return, or at least the highest potential rate of return. So therefore, it shouldn't surprise you that stocks typically do much better than bonds, although what we have to keep in mind is that those graphs that they're showing us take place over many years. You can have, for example, even with a safe security, you can have a couple of bad years in there. But in general, if you're looking at the big picture over many, many years, typically stocks will outperform bonds. But again, there's a lot of risk involved. So what normally financial planners recommend that you do is try to have a mixture of both of them in your portfolios. In other words, don't just only hold stocks or only hold bonds. You should try to have some of each so that you've got some safe returns mixed together with other returns that could be risky, but also could give you a very nice little rate of return. So, in fact, what they often recommend is that when you're young and first starting out, that you hold primarily stocks in your portfolio. And then as time goes by, you can slowly reduce the percentage of stocks in favor of bonds so that by the time retirement comes around, you have a large percentage of your portfolio invested in bonds. And also, the other thing they recommend you do is don't panic. Just because your stocks went down 10%, don't sell them just because it makes you nervous, because they probably will bounce back eventually if the companies themselves are doing very well. And this happens all the time. People panic when the prices go down and they sell them, when in reality, they probably should be buying more because then they're able to get the stocks at a bargain price. So imagine yourself owning Apple stock and you think, wow, this is a great stock. And all of a sudden there's an announcement and then the price goes down 10%. Um, well, sure, they're going to have a rough couple of years maybe because something went wrong, but in the long haul, it's what should almost certainly be one of the most prosperous companies in the United States. And so if you think in terms of the big picture, not only should you not be selling your Apple stock when it goes down 10%, if anything, you should be buying more of it because now all of a sudden you can think of it as a bargain. So bonds, though, are a great way to have current income, which again becomes more and more important as you approach retirement age. But even then, there's risk involved. So, in other words, what they're going to tell you to do is not buy a single bond, but buy a portfolio of bonds so that the risk can be spread out over all the bonds that you're holding. And so, this way, you could, for example, hold bonds from different sectors of the economy or with different maturities or different credit ratings, so that if something does go wrong, you have a lot of opportunities to make up for it with other bonds in your portfolio that are doing very well. So the name of the game is something we call diversification. What does that mean? You hold assets that expose you to many different kinds of risk so that it's highly unlikely that your portfolio will lose substantial amounts of money at any given point in time. Now, I did mention, I think once before, though, that many people consider bonds to be very dull and boring. And if you watch any investment show on TV, they'll spend maybe a minute telling you what's going on in the treasury market. And then the rest of the show, 99%, is going to be about stocks because that is what is considered to be exciting. Okay, stocks are fun. You can think big. You can dream of making tons of money in the stock market, and many people do, as long as you are willing to put in the time and the research to truly understand what is driving the values of these stocks. It can be very lucrative, but it is something that you can't let it go. In other words, you've got to put in the time and the effort and really make yourself very knowledgeable about what's happening in the markets if you hope to make money in the stock market. Okay, it's not for the faint of heart. but it can be incredibly lucrative if you do it properly. In fact, we all know the name of a very famous investor, Warren Buffett. Where did he make all his money? From investing. That's what he does. He's an investor, and he's made himself crazy rich just by being able to understand how the markets work. And so maybe you could be that next Warren Buffett. Who knows? All right. Well, anyway, so now we can turn our attention back to stocks again. And let's see, where are we? Hold on. Let me get it open. Here we go. It's called How Does the Stock Market Work? All right, let's take a quick look at this. All right, so next up is how does the stock market work?
We don't know what carpet to get. Remember the Chilean songs?
Well, that was pretty cool. So basically, they're making a very important point. Really, market prices come down to what people think is likely to happen in the future. You saw that they were saying how if the perception is that the company is in trouble, people will sell their shares, and all of a sudden the price actually goes down, and it becomes a self-fulfilling prophecy. So that's why when the price goes down, you may say to yourself, I think that the market is wrong, that the company is on solid footing, and that I will not be the one who sells it because you know, I think the company will do just fine in the future. And so when the market sentiment returns and the company seems to be doing well again, the price will only just keep going right back up again. So it is important to keep in mind that, like I said in the video, stocks can be profitable as long as we understand that they are meant to be a very long-term investment, meaning years or even decades. Whereas the people who try to chase every nickel of profits by constantly buying and selling may not do as well because, first of all, it's hard to outwit the market. Secondly, that can lead to a lot of what are called transactions costs, where you're paying a lot of money to buy and sell these shares, and that could easily swallow up any profits that you might make. So, and then they mentioned in the beginning, in the early days of a corporation, the the funds that they need are not likely to come from the stock market. Instead, they may come from individual investors. You may have seen this show on TV called The Shark Tank. Does anyone know that show?
Yeah, I've heard of that show.
What goes on that show?
People like go to these investors and pitch their product to them.
And what happens? What can happen in that show? What are they hoping?
They're hoping that the investors buy into their idea, and the investors rather can or can't.
That's right. They either say yes or no. So usually what ends up happening though is the people will come in there and they'll say, well, I need $100,000 and I'd like to trade that for 10% of my company. And then the sharks will typically offer them less money and they'll ask for a bigger percentage of the company, or else they'll say, no, I'm just not interested. So those sharks are often referred to in the markets as angel investors because they provide cash when it's needed the most. But keep in mind, though, that what they're asking for is partial ownership of that corporation. So that's why sometimes people will be given an offer and they'll say no because they think the sharks are asking for too big a percentage of the company. In fact, there have been a few close calls in corporate history. For example, there was a point when Facebook could have been sold to, I think, Google for a fairly trivial amount of money by today's standards. And they said no. And the same thing, I think Amazon also had the opportunity to sell it to another corporation, but they chose to hang on. And of course, they made the right decision in both cases. But yes, you can see, like with news, with the internet, with all the news that is available to everyone, even the slightest event in the market can cause the price of a stock to fluctuate quite considerably because everybody knows what's going on all the time. So that's why you've got to keep your eyes open and think about the long term when you're buying stocks. Okay, I think that's really the message of this video. All right, now what else do we need to know about stocks? All right. Oh, by the way, did you find that interesting? The Dutch East India Company, which you've all heard of, I'm sure of it. They're considered actually to be the first corporation in the history of the world. They were incorporated because it was such a risky enterprise that they're involved with, that they couldn't really realistically operate unless they knew that the owner's personal wealth was not at risk if the company went bankrupt. So that's another way in which the Dutch East India Company was very pathbreaking in the sense that they were the world's first corporation. And of course, when an economy reaches a sufficiently large size and companies start getting bigger and bigger, it really becomes impractical to have a situation where there's no corporations. In other words, you must have corporations to protect the owners of the corporation from personal losses. And that way, it's the only way that companies can get big enough to do things like building railroads and building bridges and dams and things like that. All right. Well, anyway, let's see what's next. Oh, here we go. How do investors choose stocks? Okay, this kind of is a follow-up to what we were just looking at. So hold on one second. There we go. Let's check it out. All right. Well, I thought that was a very good overview of the sort of the different outlooks that people take with their investments. Like I was saying before, that you might want to think in terms of the very long haul, where, of course, markets are inefficient at different points in time, but overall, in the long run, stock prices should accurately reflect the profits of those corporations. So if you buy a portfolio of stocks that you really believe in, there's no point in buying and selling them every day. You hang on to them, and in the long run, you should do very well. But and you also save a lot of money, because remember, every time you buy or sell a stock or a collection of stocks, there are transactions costs involved. There are fees. Even Robinhood. Well, I'm not sure about Robinhood, but there are usually fees involved with buying and selling stocks. So if you buy and sell too often, you may run yourself into trouble. Does it really? Vanguard 55%? Man. Now that's unusual, but it it does happen. So now that is an index, and it's an index which is a collection of funds. So you don't want to buy individual stocks for the most part. You're probably better off buying into an index. The most famous one that he mentioned in the video is the Standard & Poor's 500. And by the way, it's the same Standard & Poor's that rates bonds in the bond market. They have created an index which consists of the 500 largest stocks in the U.S. economy, and you can actually buy into that and have a very well diversified portfolio that just tracks the market. And if you hang on to that long enough, you should do extremely well. And then you never have to make another trade again. Whereas they mentioned the active traders are the ones who are constantly buying and selling, looking for bargains. They're trying to find stocks that are underpriced and buy them. And they're also trying to sell stocks that are overpriced. And they can make money too, but I would imagine it's much more difficult than simply holding on to a fund like the S&P 500 over a long period of time. So while there's room for both types of investors in the economy, for most people who aren't specialists, they're probably better off simply buying and holding funds for the long haul. All right, now let's see what's next. I believe, let's see. Oh, this one is more of a big picture look at financial markets in general. Okay, so let's take a look at this. All right, check this out.
Want to know where to invest $1,000 right now? Hi, Rex Moore with The Motley Fool. And if you know us, you know how famous we
Although modern day trading and investing is mainly computerized, many people still associate the markets with the open outcry system and the traditional hustle and bustle of the New York Stock Exchange. Those days may seem like a distant past now, primitive in some ways, but even those more traditional approaches were an evolution from what the markets had started off as. So what was the first stock exchange? How was it formed and what was being traded?
All right. So are we done with that one? Well, I
Yeah.
thought that was pretty interesting. Who knew that financial markets go back that far? Like he kept saying in the 1300s in Venice, they were already trading government debt among themselves. And so you can see that formal stock exchanges didn't get going until later on. They mentioned the first one in there somewhere. I forgot the exact date, but the New York Stock Exchange, by comparison, is fairly new. It was only opened in, I believe, the 1790s. In fact, let me go double check that real fast.
Didn't they used to do trading in France's Tavern?
It's possible that would have been a popular way of trading stocks, especially before the stock exchange opened. There was really no other way of trading stocks except to literally get together with other traders and buy and sell. And it was often done in taverns or coffee houses. That was, in fact, that's really how trading got started in London. In fact, the very famous insurance company, Lloyd's of London, that's how they sold their insurance policies. They didn't have an office. They would visit coffee houses and they would sell their products to the customers. And in fact, in those days, speaking about insuring or going out on these long voyages that were very risky, when Lloyd's first started out, what they were actually doing was offering to insure different types of cargoes on these ships that were going out for long voyages. And it was actually possible to insure just some of the cargo, not all of it, not the ship, but just individual components of that cargo, because they were very worried that if the ship sank, there would be no money coming in. So a lot of this activity did take place in taverns or coffee houses until the first stock exchanges started being built. And according to what I'm seeing here, the New York Stock Exchange formally opened up in 1817. So France's Tavern, of course, had been there well before that. In fact, France's Tavern, let's see how old it is going back to now, I've been there many times. I don't remember the exact date when it was open, but I do know that George Washington went there many times. And in fact, he said goodbye to his officers after the Revolution at the Francis Tavern. So let me just quickly see if I can find out how old it is. According to this, it was opened in 1719. So there was 100 years there before the New York Stock Exchange opened, where people might have stood around or gone inside and traded stocks or whatever was available at that time. And so, in fact, a lot of the trading before the New York Stock Exchange opened up took place on those very streets near where the New York Stock Exchange is located now. When the Dutch first got there, and that part of the city was called New Amsterdam, they did exactly that. They stood around outside and they traded directly with each other because there was no physical building where stocks could be traded. All right. Now, they did mention something interesting. They kept talking about ICOs, and I realized I'd not heard of that term before. IPO means initial public offering, which refers to the first time a corporation issues shares of stock. It's a big deal. It's a very, it's almost like a big celebration. If you ever are down in the Wall Street district when this is going on, it's almost like a big party is taking place. And there's signs all over the place reminding everybody that today is the big IPO for this corporation or that corporation. But according to what I'm seeing here on my internet, ICO is the equivalent for a cryptocurrency. It stands for initial coin offering. So if somebody comes up with a new cyber or cryptocurrency, then they try to sell it to the public through an ICO. How do you like that? Okay, but anyway, so we've got another video here. This one is more about the different stock market indexes, like the Dow Jones and the NASDAQ and the S&P 500, which are awfully important because at this point in time, if you're looking to hold a very well diversified portfolio, there are ways you can invest directly into these indices. So let's take a look at these. All right, here we go. All right. Well, that was kind of important and interesting. Those are really the major stock market indices that you're most likely to own stocks in or invest, as the case may be. So now, this is one that I wasn't sure if I should show it or not because it's not really about the stock of the bond markets, but it is becoming more important. Oh, yes. Go ahead, Maya.
I have a question. Does those like sites make profit out of their information?
Did the
Like,
what?
like does the Nasdaq make profits out of the job they do?
Oh, they earn fees by the trading that takes place. Yeah, they definitely earn profits. It's a profit-making organization. I don't know the exact details about how their fees are set, but in order to be listed on the Nasdaq, these companies have to pay for that privilege, and they provide a lot of services, which of course investors have to pay for. So, but yes, they are making profits.
Okay.
All right. Now, so this is the one I wasn't sure about, but since they mentioned the ICOs in the other video, I think we'll look at this one. Now, this is one of the most mysterious things I've ever heard of in my life. And some of you may be familiar with this and some of you may not. We're going to watch this video now, and it's called Bitcoin. just because this is now becoming more and more relevant as a type of investment. And because it's so mysterious, I don't really understand it. So I'm dying to see this thing myself. But definitely, if you look in the Wall Street Journal or any other source of information about financial markets, you'll definitely find a section that talks about cryptocurrencies. So either these things will fizzle out and disappear, or they will prove to be an important source of funding and investing in the future. So let's just check this one out as well, even though it's a little bit different than what we've been doing up to this point. It still could be considered part of the financial markets. All right, so let me send this out there. And let's take a look. And if you can explain it to me, that would be very much appreciated. Wow. I don't know. Did anyone understand any of that? Um, all right. Well, I thought it might be interesting, but I'm still just as mystified as ever. Does anyone else here have any dealings with Bitcoin?
Not
No.
too much, no. A little bit. I've looked into it a little bit, but nothing too
Right. And
much.
that's true. There are others too, by the way, besides Bitcoins. In fact, there is actually, let me get this back going. If you look at a website like CNBC, which is where you can find a lot of useful information about all kinds of markets, not just stock markets. Up here somewhere, there's a listing for cryptos. There it is. And I think they have quotes right now, like, look at all these guys. The Bitcoin itself is currently selling for around $58,000. And then there's all these other ones like, oh my God, Ethereum and Ether and Gemini. And I guess these are exchange rates between the different ones. It's so confusing.
Yeah,
But yeah, like
Ethereum in the beginning of the year was 1,000, so it doubled like 100% in 2 months.
wow. Well, I guess it's a great way to gamble, I guess. Like if we could buy like this one for $2.71, maybe next year this time it'll be worth $1,000. Who knows?
Yeah, I bought like 4,000 shares in Dogecoin. Hopefully,
Oh, and how did it do?
it's still the same price. It's like 0.06.
Oh no. But that's right. At least you didn't lose all your money. There's so many of them. Man, Algo. Is that a coin? Algo. I don't see Algo here. Man. It's so confusing. But yes, like you said in the video, like a lot of people feel that this will just eventually fail, and others think it's the wave of the future. You just don't know with something like this. Anything could happen. And so that's why they're so risky, because especially if you don't even know what it is. I mean, at least with a stock, you can point your finger to it and say, this is what a stock is. Now look at this chart. You go back here to April of 2020, 1 year ago, this Bitcoin was selling for about $6,900, and now it's up over 57,000. That's a pretty nice rate of return. But who knew? So who knows if it may not be worth that much next year? It's hard to say. So if you're really, have some expertise in this area and you have a little extra money to invest, you might want to throw this into your portfolio just to get some diversification. But it seems to me like this would be unbelievably risky to get involved with in any big way. I mean, like I said, unless you do this all day long, and even then, nobody knows what's going to happen with this stuff. But it is interesting. All right, so I think that's the last of our videos for now. As much fun as they were, we have other things to do here. So why don't we get back to our chapter 10, where we're about to look at our discussion about the loanable funds model, which is really what this chapter is all about. Loanable funds, it's just a general term that refers to borrowing and lending between individuals and banks and corporations. So the loanable funds market is simply the market in which all the individual financial markets are combined. So stocks are part of this, bonds are part of this, currencies are part of this, you name it, including, I suppose, Bitcoins. And ultimately what this market is doing is determining the level of interest rates in the economy. Now, later on, we'll see that the Federal Reserve System is actually in control of interest rates, but the markets, it's the actions of the markets that the Fed is reacting to when they carry out monetary policy. And so what'll happen is we'll go through periods where the demand for loanable funds gets much stronger because the economy is growing and businesses want to expand Individuals want to buy more goods and services, and so interest rates will start creeping up. And then you get other periods where the opposite is happening. The economy is slowing down, or there's some external crisis like COVID. And so rates start to drop because people are nervous and they're less likely to want to borrow and invest or buy expensive goods and services. So we're going to assume in this discussion that there's really three main reasons for borrowing. Number one, businesses borrow to invest. Businesses exist to make money. And one way they make money is to invest in their own operations, to expand the size of their operations, to maybe create new products, maybe to move into other markets, like, for example, open up overseas branches. These are all the reasons why a business might want to borrow money in order to invest and hopefully increase their future profits. When governments like the federal government or city, state, and local governments borrow money, it's because they haven't got enough tax revenues to cover all the spending that they are undertaking. And they have to get the money somewhere. All right. How do they do it? They borrow by typically issuing bonds. And then, of course, there's also the possibility of international investing or lending from foreign sectors. Like, for example, foreign governments often buy or borrow money in the United States just because our financial markets are so large that it might be easier to borrow money here than in their own countries. Foreign corporations often borrow in the United States because they may be doing business here. For example, you may know that a lot of Japanese auto manufacturers have factories here. And so it makes sense to borrow dollars in the United States in order to run those factories. All right, well, anyway, where did the funds come from? Well, obviously, individual saving are a major part of that. Now, in a fantasy land where governments actually have budget surpluses, that could also be a source of savings. And then finally, we have international borrowing. In other words, foreigners may be willing to lend money to American companies or to American governments, et cetera, et cetera. So the savings can come from foreign sources as well. And in fact, it often does. Now, corporations in the market sometimes don't need to borrow, or they may need to borrow less if they have held on to their own savings from past years. You may have heard this term before. If a corporation earns profits and they do not pay them out as dividends, then they can save them, and they're then known as retained earnings. All right, so corporation, just for safety purposes, may decide to hang on to some of their earnings so that they have these funds that they can lean on if they need them. And those funds could be needed, for example, to pay bills or to finance their operations or to expand or do other important things with them. So again, retained earnings are simply earnings of the corporation that are not paid out as dividends. What's left over stays in their pockets, and it's called retained earnings. All right, now in this section of the chapter, we're going to be developing a framework where we try to analyze the relationship between the supply and the demand for loanable funds, just like the supply and demand for any good or service in the economy. So the quantity demanded of loanable funds will be defined as the total funds that are needed for the following purposes. 1, to finance business investment. 2, like I said before, to cover government deficits. And number 3, to engage in international investment or lending. Okay, so in other words, if, let's say, Apple decides to open up a new headquarters in Paris, that's going to cost a lot of money, and that means they will have to raise it somehow. Most likely it'll come from the stock or the bond market. Although they certainly have enough money of their own sitting around that they could spend it. Apple has an enormous amount of retained earnings that they could potentially use for any purposes that they chose, but yet they still, for whatever reason, continue to issue stocks and bonds in spite of the fact that they have plenty of money on hand. Now, the demand for the funds fluctuates in the market, but what really drives it more than anything else is, number one, the real rate of interest. You notice how we're thinking in terms of the real rate, which means the rate that's adjusted for inflation. This determines how much it's costing us to borrow. And when we think about real terms, we're thinking about changes in purchasing power as opposed to dollars. And of course, expected profits. So, I mean, of course, when governments borrow, this has nothing to do with profits. But for all other types of borrowing, typically what's driving it is the potential for profits in the future if we invest the money wisely. So that's why the demand for loanable funds can fluctuate due to changes in perceptions of the risk of the economy or how people think companies are doing. If in general expected profits are rising, then there will be a stronger demand for loanable funds. And if those expected profits are falling, then the opposite will happen. But what about the real rate of interest? Oh, and by the way, just as a quick review, the real rate simply equals the nominal rate minus the inflation rate. And of course, the whole idea here is that if you calculate the real rate of return to an asset, what that's telling you is the increase in your purchasing power instead of simply the increase in the number of dollars that you have. Okay, so the assumption here is that this is what's really driving all investment activity. Hopefully, these will be used to increase our real rate of return in the future. Okay, so the real rate of interest is used by corporations to determine the real cost of borrowing. And of course, nobody's going to borrow unless they really believe that the returns to their investment projects are higher than the cost of borrowing that money. All right, that wouldn't make any sense. So we're going to create, like I said before, just like any other supply and demand curves you've ever seen, a demand curve for loanable funds. And it represents all combinations of loanable funds that borrowers would be willing to borrow at different levels of the real rate. So you can think of the real rate as the price of borrowing money. And then in that case, that means we can put the real rate of interest on the vertical axis and the quantity can go on the horizontal axis, just like a regular demand curve. And so the result is that we have a downward sloping demand curve. In the book, they put this as DLF, which stands for demand for loanable funds. Okay, so just to distinguish it from the demand for any other product in the economy. And on the vertical axis, as I said, instead of having a price, we have the real rate of interest, which in a way is the same thing because it represents the cost of borrowing. So therefore, with high real rates, which we have here, there'll be less demand for funds. Down here with really low rates, of course, the demand will go up. All right. Oh, let me just leave it there for a second so you can catch up. So now this shows me that if there's a change in the real rate, I will simply move up and down the same demand curve. All right. So let me just quickly sneak in there another diagram here. All right, so again, here's the real rate. These are the loanable funds. And so imagine here's the demand curve. And initially the real rate is very high. Let's say it's at 6%, and people want to borrow $100 million in loanable funds. And then when the rate drops to 4%, let's say that it drops or increases to 200. So this would be known as a change in the quantity demanded of loanable funds. All right. So a change in anything that's on the vertical axis in any of our graphs will cause a movement up and down the curves that are being described. And that also means that any other factors besides the real rate that change would lead to what we would call a change in demand. Okay, so in other words, we'll see that in a minute. When there's a change in an external factor, that means the entire curve will shift, and we will call that a change in demand. What could cause that to happen? Well, in the book, they're going to attribute this almost exclusively to changes in expected profits. All right. So in other words, again, real rates changing lead to a change in the quantity demanded, but a change in something else like expected profits will shift the entire demand curve either to the left or to the right. All right. So let's see. This one I've already drawn. If expected profits increase, of course, there'll be an increased demand for loanable funds because we want to borrow more to take advantage of the higher expected profits. All right. And of course, if the opposite happens, then we would expect to see the curve shift to the left. So the one on the right could result if the economy is really booming. Things are going great and every business is doing well and they all want to borrow and expand even further. The one on the left means the opposite. The economy is struggling. We're having a crisis of some kind. Companies do not want to borrow so much. Their profits are expected to drop. Therefore, they will, of course, borrow less. And the entire demand for loanable funds curve would, of course, then shift to the left. All right, so that's the demand. We're going to think of that in terms of just profits, whereas the supply of loanable funds can come from or can be affected by different factors because the suppliers of loanable funds are savers. And what that means then is that they have other things they could be doing with those same funds if they chose to do so. Wait, hold on. Yes. So therefore, what we want to know is what outside factors could influence the supply of loanable funds. All right, well, it can come from, we know that loanable funds can come from private saving, it can come from government budget surpluses, and it can come from foreign lenders. Now, here you would imagine that the higher is the real rate of interest, the more people will want to save. And that's exactly correct. So what that means is that the supply curve for loanable funds, just like the supply curve for every other good in the economy, will have a positive or upward slope to it. So let's take a look at that. And as you can probably guess, we're going to call it SLF for supply of loanable funds. All right. Now, just like with the demand for loanable funds, if there's a change in the real rate of interest, we will find ourselves moving up and down the same supply curve. So let me just illustrate that right now with another graph. And we'll say that initially, let's say we're at 0.1, when the real rate was 4%, people were willing to provide $100 million to the market. And now at a real rate of 6%, let's say that goes up to 200 million. So what you're seeing here is a change in the quantities supplied of loanable funds. To distinguish it from a change in the supply, which would be reflected by a shift of the curve. All right, so if we move up and down the same curve, that means a change in the quantity supplied. If an outside factor causes the entire curve to shift, then it will shift either to the left or to the right. So now here, this one has several possibilities, which the book is telling us that all of these factors ultimately will influence the supply of loanable funds. So there's quite a few here. As you can see, the real rate itself, which moves us up and down the curve. But then look at some of these other ones. Disposable income and wealth. And by the way, this is one of the reasons why we made a distinction in the book between income and wealth. And so disposable income means, by the way, after tax income. Let me add that here. Then we have wealth, we have expected future income, And finally, we have default risk, because remember, if you're lending money, there's always a chance that you will not get the money back that you've been promised. This is known as either credit risk or default risk. And that is always present as long as we're lending money, except possibly to the US government. Okay, so I've already drawn this one before. All right, that's fine. You can see this is the result of a change in quantity supplied due to a change in the real rate. But then if one of the other factors changes, for example, what about disposable income? Well, what happens as you become more affluent? Do you tend to spend more of your money or less? Well, the percentage may go up or down, but the bottom line is the wealthier you are, or the more income you have, the more you're in a position to save at least some of your money. Maybe not a huge amount, but some of it. And so as we become more affluent as a society, there's a tendency for our savings to grow, if not in percentage terms, in absolute terms. And so as we become more affluent, that by itself is enough to increase the supply of loanable funds. And as you know from previous chapters, an increase in supply indicates that that curve will shift to the right as more funds become available at every possible rate of interest. And naturally enough, this implies that if disposable income falls, well, certainly the opposite will have to happen. So let me show you a quick graph of this. To the right means that disposable income increases, and to the left, disposable income decreases. So the entire curve shifts. Both of these are known as changes in the supply. Not the quantity supplied, but in the supply of loanable funds. Whoops. Caused by something except anything really, except for the real rate. Okay, so we got a few more factors here that we want to look at, and then we're going to bring these curves together and define the equilibrium in this market. So we actually have a ways to go here. So I'll tell you what, why don't we knock it off right about here? We'll carry on Monday with this discussion. And when this is done, when we're gonna move into the last couple of chapters, or the last few chapters, I guess, where we're going to be taking a very close look at the Federal Reserve System and money. Now, money is probably, as you know, one of the most exciting topics there is. And so we've got a lot of interesting ground to cover there, because money has a very interesting history, especially, well, every country, but the United States in particular has a very interesting history of its money. And we're going to analyze that in great detail once we're done with this discussion. Okay, so for now, all you have to do is basically make sure you understand what we've been doing, and then I will just see you all again next Monday, unless there's any last minute questions.
Have a great weekend.
You too. Okay,
Thanks.
bye.
Bye.
See you next time.
Have a great weekend.
Okay, bye.